All right. So first of all, good afternoon, everybody, and thanks very much to the organizers for inviting us to present today. I come from Ersel Asset Management. For those of you who may not know actually who we are a privately owned asset management company. We are based in Turin, Italy. We manage 13 billion euros assets for private individuals as well as institutional clients, and we have been in this business since 1936. So we have 80 years actually history. Having said that, this afternoon what I'm going to do, I'm going to talk about total return, how it is possible to build total return programs based on the outperformance potential of smart beta indices relative to their cap-weighted counterparts, whether it is possible and then how it is possible. In order to do that, what I'll do, I'll start with a very brief introduction, then I will define what I consider to be the key concept in today's presentation, the notion of portable smart beta. I will draw parallels, analogies, and differences with respect to its older cousin, portable alpha. And then I will actually elaborate on this idea we have had, so namely how it is possible to come up with programs with a total return objective which are based on combination, on what we consider to be smart combinations. That's why the title, so Smart2 or Smart2 beta strategies of smart beta indices relative to their cap-weighted counterparts. I will touch upon how to choose the building blocks. I will say a few words about how to hedge risk and whether it's opportune or not to time exposure to these sources of portable smart beta. And I will show you that diversifying actually a portfolio of portable smart beta strategies across different smart beta methodologies and across different geographies results actually into efficiency profiles at the portfolio level which are quite interesting. Let me start briefly with a recap of many concepts we have already heard in other presentations, other wonderful presentations in today's conference. So first of all, smart beta is the hype of the moment. I mean, basically because why is that? Because people have noticed increasingly over the last 15 years, which is basically the period of time during which the smart beta concept has existed. It was invented back in the early 2000s at Towers Watson. They have observed a long-term outperformance potential with respect to their cap-weighted counterparts. Nowadays, there are even people actually referring to cap weighting as a kind of a dumb form of benchmarking. In the marketplace, at the end of 2015, actually, there are about 400 smart beta ETFs with actually about $500 billion US dollars assets under management. We see many new smart beta indices actually coming up every month proposed by many different index providers. So there are two facts which will be actually discussed during the presentation. First one is that the outperformance of these smart beta indices versus cap-weighted indices could be actually an opportunity to enhance the performance of cash if your interest is to build a total return program, or also if you are managing money relative to benchmark to do enhancement type of strategies via standard concepts of portable performance. The only caveat in following this approach is that you need some sort of guidance. You need actually to decide how you want actually to approach, for example, the selection of which building blocks you want to use in your portfolio construction. And that's what we refer to as the Smart2 beta concept. I'm going to talk about that. So let me start by defining the notion of portable smart beta. It's very easy. I mean, I think that I will start by the older cousin, portable alpha. That's an old concept. It was invented back in the late 80s at PIMCO. At that time, PIMCO was managing a very successful range of fixed income products. They thought they had a lot of skill in those products, and they wanted to transport the alpha generated by those fixed income products onto equity managed S&P 500 benchmarked products. So suppose that you have spotted the fund of your dreams, capable of generating a skill alpha, the alpha element. Well, what you do, you buy this fund. The technique is very standard. You know then that its performance actually comes partly from exposure to traditional market risk factor, partly comes from exposure to a collection of alternative risk factors. If we are basically in the equity space, we know which one they are, so the usual suspects, value, size, momentum. And then on top of that, you have the skill element. And I deliberately chose actually to put it in this shaky actually representation, because about alpha we know essentially three things. First, that it's a scarce resource. Second, that it tends to be very costly. And we heard about it this morning, it's not very persistent. That's actually not what I'm saying, so literature shows. But let's suppose for 1 second that you have found actually the really good actively managed fund even with persistent alpha. What is portable alpha then? Well, you call your team of financial engineers, you ask them to actually get rid for you of market risk. They will do that with standard hedging technique. They will sell futures or total return swaps. The result of that is basically what you get. You get portable and then in quotation marks alpha, because in reality what you get is a collection of exposures to alternative risk factors you were not capable of hedging away, plus what you were after in the beginning. So the element of value added by the investment manager capabilities. The idea of portable smart beta is exactly the same idea. The only difference is that what you do, you buy on the long side a smart beta index. There are many, okay? You buy, for example, the S&P 500 low volatility or minimum variance index. Once again, you know how to decompose the performance of this index. Where is it coming from? It will come partly from exposure to the market risk factor, partly it will come from exposure to a bunch of alternative risk factors. I mean, there is not going to be, of course, the green part, the green building block, the skill element in this construct. But then what you can do the same kind of idea. So you hedge away market risk by selling futures. Nowadays, we have plenty, actually, of smart beta indices which are defined on universes for which hedging instruments actually exist. So like the S&P 500 or the STOXX 50, other indices as well. And what you remain with, essentially, is the notion of portable smart beta. Portable smart beta is nothing but a combination of exposures to alternative risk factors. Okay, again, we know which ones. Okay, if you are in the equity space, it's going to be value, momentum, and size. So the first question is, okay, this looks potentially doable, interesting, why not? I mean, if it's true, as we see actually that smart beta indices outperform over time cap weighting, it could be something we can do. What are the differences then with respect to portable alpha? Let's compare the two approaches on 4 different axes, which have to do with transparency, cost, liquidity, and funding needs. Let's start from transparency. And think back at a portable alpha program. So you put money, commit money to a set of active managers, the aim being actually extracting skill from each of them and putting them together in a portfolio. Transparency degree is low because you will need the disclosure of the positions, and disclosure of the positions for most active managers is not something which happens that regularly. And if it happens with some delay. Conversely, if you buy into a smart beta index, the degree of disclosure is high, very high, because you have on a daily basis the constituents, you know exactly what's the index rule book, so you know everything about what you are buying. In terms of cost, there is no comparison. The cost of a portable alpha program is very high. You need to pay management and performance fees on the actively managed product you buy. When you buy into an index, a smart beta index, the cost is low. And actually, there are techniques which you can exploit. For example, if you access a smart beta index via total return swap, and you do that with a counterparty which is capable actually to, for example, recover tax on dividends, you can even pay negative financing, which is what we experience actually because we do that in practice. Liquidity, how to manage flows. You have a selection of actively managed funds. You have, you want to base your portable alpha program on. Then you have to manage flows from one to the other. You have issues having to do with relationship. It's very difficult to move flows, because you can hurt the relationship with your bunch of active managers you work with. Indices, smart beta indices, are emotionless entities. So essentially, you can move capital, with a maximum degree of freedom, the maximum flexibility. Plus, since they are tracked by ETFs, the underlying liquidity needs to be there. So it's very flexible as a program. And finally, funding needs. If you have to fund a portable alpha program, funding needs tend to be high. If you need to fund actually a portable smart beta program, no problem. If you access your smart beta indices via swaps, you will have maybe to post some margins, some collateral. But you can even think of applying a moderate degree of leverage. So by this point, I hope I convinced you that there is an opportunity in this type of approach, A, and that compared to traditional portable alpha-like approaches, this kind of approach may have its own merits. So let me then actually move and discuss what are the principles you should follow in order actually to put together a program with a total return objective based on a collection of portable smart beta strategies. And here I'm going actually to state, first of all, what we believe are the 3 key principles one should follow. First principle is optimal selection of portable smart beta building blocks, if possible with some theoretical kind of support. Because the issue is, out there you have literally dozens, actually, new smart beta indices, and some of them very complicated. The point is there actually a selection of smart beta indices we can base our methodology onto? And I will show you actually what we think a possible answer could be. Second, you need to think about 2 things. We know that portable smart beta is based on alternative risk factors. We heard actually in previous presentations that alternative risk factors are subject to cycles. So you need to be able to perform some market timing, have some simple market timing discipline type of rules which allow you to not to be exposed to a certain source of portable smart beta when you think it may not be paying off. That's A. And second, you need to know actually how to do your hedging. I'm going to show you actually that an efficient, what we think to be at least an efficient risk hedging methodology, which is based on the notion of volatility targeting and which is flexible. In other words, which is fine-tuned to the underlying actually market regime. And finally, the last point, the last principle is the one we heard also this morning, so it's diversification. I will show you how putting together actually portable smart beta building blocks which are defined on different methodologies in terms of smart beta definition and different geographies results actually into an efficiency profile in terms of return versus risk trade-off, which can be very, very interesting, at least to us. Now, all of these, I want to just to actually clarify, it's not theory. We do that. This is actually the approach we have been following since 2013 at Ersel in our investment program to gain access to alternative risk premium. What I'm going to show you has been actually in place for 2 years, and we think it works in practice. So let me start first. So I will try now to answer the 3 questions. Okay, so which building blocks? First question. Second question is, should we time or not, and how should we hedge our risk? Third question, what happens when we diversify portable smart beta building blocks together? What do we get? First question is, which smart beta building blocks should we actually look at? And there I make reference to a paper which I wrote. The title of the paper is the one you see, so Stochastic Portfolio Theory Optimization and the Origin of Rule-Based Investment. It got published in Quantitative Finance last year. So what kind of guiding principle should I follow that? I'm using the framework of stochastic portfolio theory. It's a complex name for a simple concept. What is stochastic portfolio theory doing? Stochastic portfolio theory is a descriptive approach to finance and allows actually to write down a stochastic differential equation expressing essentially the relative logarithmic behavior of a portfolio return versus the return of a cap-weighted benchmark. And it does that, so this relative log return can be decomposed into 2 terms. One term is noise, which cannot be predicted, but which under certain circumstances can be shown to remain bounded. And then there is actually a drift term. Drift term actually regulates the long-term behavior of a logarithmic drift term relative between portfolio and benchmark, governs the relative behavior of portfolio versus cap-weighted benchmark over time, in the long term. What we have asked ourselves has been the following question. What should be the way, if I am given this formula, which I decided not to show, but if you wish later on we can actually discuss it. If I'm given actually this framework of stochastic portfolio theory and I have this formula describing the relative log return of portfolio versus benchmark, I look at the drift part and I ask myself, what if I want to maximize long-term drift while keeping active relative risk between portfolio and benchmark fixed, so tracking error risk fixed? What do I get? And the answer is very surprising because when you tackle the problem that way, you find that you can work out the optimal solution. That's what was done in the paper analytically, so you can solve it. And you can show actually that the optimal solution is based on the linear combination of 4 smart beta building blocks, what we call 4 smart beta seeds, which are equally weighted portfolio, minimum variance portfolio, 1/, volatility portfolio, and the portfolio weighted by contribution to return given by dividends, cash flows, okay? So kind of a high dividend type of portfolio. Why the result is interesting? I think it's interesting for two reasons. The first one is theoretical, because what we have seen in the industry up to now is that all these smart beta indices are introduced based on some sort of heuristic principles, okay? And then later on people say, okay, but why equal weighting does better than cap weighting? I'm going to do some factor analysis and show that actually it has to be the case. What lacks is a derivation starting from a kind of utility maximization perspective. So here, stochastic portfolio theory allows you to write down this utility maximization formula, and then you can solve it, and you find this result, which is, I think, nice. Second reason of interest is that the building blocks which emerge out of all these possible smart beta indices which you can think of are the simplest one possible. So you get a solution which is at one time elegant, okay? And Italians have a passion for elegance, as you all know. And secondly, it's elegant and actually it's very parsimonious. It's nice. It's, you get really the simple things, the simple atoms of smart beta are the ones which emerge. So we got this result, then actually we started to talk to STOXX, and what we did essentially was, let's actually try to build an investment strategy based on portable performance, based on precisely on these four very simple building blocks, okay? But we proxy them with STOXX-based indices, which are available because STOXX does have expertise in the smart beta field. They do have 1/over volatility indices, minimum variance indices, of course, equally weighted indices, and high dividend indices. And that's what actually was written in a second paper we wrote, which is actually available, I think, on the Research Insight website, the Research Insight section of STOXX website. So far, choice of building blocks done. Okay, we have chosen based on theory, and again, if there are questions, I'll show you the formula and we comment on that. I'm very happy. It's a topic which passionates me a lot. The building blocks are going to be the four I mentioned. So minimum variance, once again, high dividend, equal weight, and 1/over volatility. Second question is, what should I do now in terms of how should I manage my risks? And there are two sources of risks which you have to think about. First of all, should we time these portable smart beta entities, okay? And the answer is, in our opinion, yes. Why so? Because, or at least we should have simple stop-loss rules, because we heard this morning that you have, with alternative risk factors, which are at the basis of your long-short strategies, so smart beta long, cap-weighted short, you can have periods of severe underperformance, which can last a lot of time. Here I have two examples. What you see is the portable smart beta strategy on the Europe minimum variance index on the left. So the strategy is the blue line. On the right, you have the same strategy. The hedging is done on a beta-adjusted basis. You have actually the European high dividend strategy, long, short, the cap-weighted index. In red, you have the behavior of the underlying universe, of the underlying market. What you see is that there have been periods, in particular for the dividend strategy, they have lasted quite long, of continued underperformance. So you need a rule which can be systematic, for example, so it's the best thing because it protects you from, like kind of behavioral biases, to tell you when it's time to switch off the exposure to this strategy, okay? Second point is, how should I do my hedging, okay? And here what I'm going to just introduce and discuss is the notion of volatility targeting. You need to manage the volatility of a portable smart beta strategy. The idea is, I tried actually to represent the need for that with this chart, which shows you actually the behavior of ex-ante volatility of the portable smart beta built on the STOXX Europe 600 minimum variance index, long, short, the cap-weighted STOXX Europe 600 index, beta-adjusted. You can see that the volatility moves a lot. It goes from a minimum of 2% to a maximum of close to 10%. And so what can you do in order to manage it? The idea is basically comes back to, again, theoretical work, which was done in 2010 by a guy called Guido Gyse. I think at that time he was actually a STOXX employee when he wrote this paper. And basically what he showed in this paper is that you can use the notion of volatility targeting. What do? You basically ex-ante establish a budget of risk you want to allocate to your long-short pair. And then when the basis risk between your long and your short increases dramatically, you reduce exposure to the pair. And conversely, when the risk decreases, you allow yourself even perhaps a moderate degree of leverage in order to keep over time your ex-ante risk budget maintained and constant. what Guido Ghise shows in his paper is that for any strategy with positive Sharpe ratio, actually you can mathematically prove that the volatility-controlled version of that strategy is going to have a better efficiency profile if your target volatility is not too higher actually compared to, or is not higher than the historical volatility of the original strategy you work with, okay? So, and it does work. We see in this slide here what I showed you before. So this is the strategy, the portable smart beta strategy based on the Europe minimum variance index. So you are long Europe minimum variance, you are short the cap weighted index. You see that beta adjusted, you see that over time, well, it's nice, you get about Sharpe of about 1. This is done between 2003 and 2016. So 4.5 return for the same degree of annualized risk. You put on top volatility targeting a volatility level of 5%. And that's what you get. You get a volatility of 5. That's, thank goodness, I mean, that's what you want to obtain with your volatility targeting exercise. But look at the return. The return goes to 6.5, and the Sharpe, the efficiency improves by a quarter, which is highly significant, okay? So now, okay, volatility targeting is the concept we should base our hedging. But then, again, there are several ways of doing volatility targeting. I'm going to actually say still this point because it's very important. You can actually do just volatility targeting. So you have a long-short pair, long smart beta, short cap weighted. The exercise is I fix a volatility and or a variance, and I need actually to solve for the weight to assign to my hedging instrument in order to meet that volatility objective. Second order equation, it's a problem which is quite easy to solve. What you achieve in that case is, of course, constant volatility for your long-short strategy at the target you have selected. But you can see that you can have a low degree of positive market directionality depending on the level at which your target is set. So it's a strategy which is not market neutral. It has a positive small degree of market directionality. Second thing you can do what I call market neutral volatility targeting. So the idea is that in this case, you first beta hedge your pair, okay? And then on top of that, on your beta hedged pair, you are going to impose that the volatility has always to be constant through time. So in this case, you achieve a strategy which has constant volatility and no direction exposure. There is yet a third way of doing it, which is what I call defensive volatility targeting, where the idea is the following. You hedge money neutral, so $1 of smart beta, $1 of cap weighted short, and then I apply volatility targeting on top. In that case, what you obtain is constant volatility, but you can obtain a possibly low degree of negative market directionality because most smart beta indices, or some at least of the ones I have selected, tend to be defensive, so they have a low beta. Okay, so in money neutral terms, you can end up with something which is actually, which has a slightly negative beta exposure. So what we do in our, process, in our way actually of working is the following. I mean, we think the underlying principle is the following. We have, portable smart beta strategies defined on a market universe. The idea is that we have seen there are 3 volatility targeted hedging techniques. 2 of them have a bit of residual market exposure. 1 of them is beta neutral. Why should I actually give up the possibility, if I am working on a total return product, of participating to market performance when I think that there is actually potential? And why should I not use the fact that by being slightly short the market, when the market is going south, I cannot protect myself from periods of, where I could be potentially hitting my performance. So we have designed an efficient risk hedging methodology which works, coupled to market timing, which works in the following way. When we invest in a portable smart beta strategy, how do we approach the problem? Look first at what is the regime of the underlying market the strategy is defined upon. So if you have long S&P 500, low volatility, short the cap weighted index, go look. How is the S&P 500 doing? In what kind of market regime are you? Is it a favorable market regime? And then, okay, then fine, let's choose the risk hedging technique which leaves me with a positive, small degree of positive directionality. Is it a market regime I don't understand, I don't know where it's going? Well, then choose the second one, so beta neutrality. Is it a market regime which is turning sour? Then do the defensively hedged volatility controlling is the best risk hedging technique you can have. This first step allows you to choose the type of hedging associated to the portable smart beta strategy. There is yet a second step, because at that point you are going to check how the portable smart beta strategy is working. The underlying alternative risk factors, which explain the bulk of the performance, are they being remunerated or not? And the idea is we have introduced a very simple timing signals, which are based on simple trend following algorithm, which help us identify the state of the portable smart beta strategy, the regime of the portable smart beta strategy. Is it a positive regime? Yes, okay, then let's expose ourselves to the strategy. The trend following, is the strategy undergoing a negative trend? Then the idea is that I cut exposure to the strategy and I go cash. If I am in a lateral regime, I maintain the previous positioning. Now, all this sounds very abstract, but let's look how it works in practice. It's very interesting. Here, what I do, I take actually the portable smart beta strategy based on minimum variance indices on 3 geographies. So the blue is Europe, the red is US, the green is Japan. So these are all minimum variance indices. And what you see in the 3 charts is actually the 3 hedging techniques. Okay, how on average, on a daily basis, what is the degree of average daily return you get as a function of the performance decile of the underlying market. This is called an optionality profile. It's like, you know, your portable smart beta strategy is like an option on the market. You are going to check how the payoff of the option behaves. What you see on the left, we look at volatility targeting. It has a little bit of degree of positive directionality. You can see that on average, when the market is in its best deciles of performance, you get a positive contribution to return. When you are in a phase where you are in a regime where the market is going lateral, nowhere. I mean, it's a regime you don't understand. That's what I used. So you don't know how it's going. So we are in the intermediate performance deciles. What you see is that the beta hedging, the second actually chart on the right, on the top right, basically shows you that you are still capable of getting a little bit of positive return on average on a daily basis. And finally, when the market turns sour, so you are in the worst deciles of market performance, essentially you see that defensive volatility targeting is the technique which allows you to still get positive contribution to return. Having so spoken at length, I think, about market timing and risk hedging, efficient risk hedging, I'm going to close by showing you the power of diversification. So here in this slide, I think it's very nice and very interesting, actually. What you see is all the building blocks, so the portable smart beta building blocks. The color identifies essentially the smart beta methodology, and the symbol identifies the country, the geography. So you have that squares are for European strategies, circles for US strategies, and triangles for Japanese strategies. Okay? So what happens is that you see the risk return for each single source of portable smart beta already with the efficient risk hedging and market timing. And then you see what happens when you put them together in a portfolio which is built following the principle of risk diversification. So a risk parity, keeping into account correlation among the different portable smart beta strategy. That results in the shift of efficiency you observe. So you go northwest very strongly, you achieve a portfolio, and this is actually annualized excess return after cost. We already keep into account trading costs for the swaps and the cost of actually writing the swaps themselves in the backtest. You get a return of 5% for a target volatility which we have set in advance of 4 annualized percentage points. And this is actually the kind of track record you can expect. So again, it's a net excess performance evolution. There is no cash. Well, big deal. These days, of course, you don't get much from cash, but in the past there have been periods where you would have got more. So the red line is the strategy, and then the dashed line is the behavior of the market, proxied by the MSCI World. What you can see is that, okay, you have, as I said, with a 4% risk, an annualized excess return of 5 percentage points, so a Sharpe of about 1.25, with a maximum drawdown for this risk objective of about about 7 percentage points, 6.8. Conclusions, and I'm really done. First, I hope I have convinced you that portable smart beta strategies represent a cheap and transparent, actually, performance enhancement opportunity. You can use this performance enhancement opportunity applied to cash for a total return objective, or applied to a benchmark if you are interested in doing so for an enhancement objective. Second, I didn't show it to you, but if there are questions, I'll be happy actually to go about them. The Smart Beta portfolio maximizing long-term relative drift relative to a cap-weighted benchmark is a combination of 4 atoms, 4 seeds, which are the simplest one you can think: equal weight, minimum variance, inverse volatility, and cap weighting. So, well, the way we approach, this type of investment programs, I think I have explained it in some detail. And I will say that, I will conclude by saying that in September we are actually launching a fund, which is going to be a UCITS Luxembourg fund. The fund will be based entirely on Smart Beta indices provided by STOXX. Okay, so there is going to be a, let's call it partnership, a joint venture with STOXX on this, on the use of their indices. And the idea is to launch a product with low volatility, 4%, and with a return objective net of all fees of about 2 percentage points above EONIA. So, and I think with that I would thank you. So if there are any questions, I would be very happy actually to try to answer. Thank you very much.